You know that feeling? Watching the financial markets, numbers just flashing, headlines flying by. It really can feel like trying to drink from a fire hose sometimes.
Oh,
So much noise. You just want to know what actually matters. What's the real signal? Well, welcome to the deep dive. We're here to be that shortcut for you, cutting through all that noise. Today, we're taking a really close look at a financial briefing from July 28, 2025. It's absolutely packed. Global markets, central banks, digital assets, the works. Stakes seem high, lots of rapid fire events coming up. So let's unpack this daily briefing. Let's see what's truly driving the global financial scene right now.
exactly. And our mission here is just that. Pull out the crucial bits, connect the dots that might seem, separate, and really highlight what matters for your understanding. It's not just the what, it's digging into the why behind it all. That's where the value is.
Okay, let's jump in then. Current market pulse. The executive overview in this briefing says global risk assets started the week cautiously constructive. U.S. equity futures are flat. Treasury yields haven't moved much. Dollar index just under 98. Sounds pretty calm, doesn't it?
It does, yeah, on the surface. But if you zoom out a bit, the briefing points straight away to investors digesting things. Mixed trade headlines, a really heavy macro calendar coming up.
Ah, okay.
So while the big picture might look stable, there are these strong undercurrents. Suggests bigger moves can be coming, like the quiet before,
The storm, potentially. And where are those currents strongest? The briefing highlights digital assets, right?
absolutely. Bitcoin's been consolidating above $119,000. Ethereum's knocking on the door of $4,000. And crucially, spot ETF flows show this sustained rotation toward yield-bearing smart contract platforms.
Okay, yield-bearing smart contract platforms and spot ETF flows. Can you break those down quickly for us? Make it simple.
Sure, think of a yield-bearing smart contract platform like a digital account where your crypto earns interest. It's active, generating returns.
Okay, earning yield. Got it.
And spot ETF flows. That's just money moving directly into or out of funds that hold the actual Bitcoin or Ethereum, not futures, the real thing. So real
Okay.
cash is moving into these crypto assets that can earn you something back.
That makes sense. Thanks. And just quickly, foreign exchange, what's the picture there?
FX markets. Well, the dollar's remained a bit soft against Europe,
Oh, okay.
against commodity currencies. And here's something to watch. USD/JPY. It's testing levels where Tokyo might start talking about intervention, verbal warnings.
Because the yen's getting too weak.
Exactly. Tied to the Bank of Japan's policy, keeping their rates low while others rise, that yield curve control.
Right. Now, this is where it gets really interesting. The desk take section. It warns of a critical 72-hour window, a confluence of policy events expected to drive a volatility spike. Rates, FX, crypto, everything. They even recommend cutting overnight VAR budgets below normal levels through Thursday. Okay, VAR, what does cutting that mean in plain English? And why this specific 72 hours?
Okay, VAR is value at risk. It measures potential loss. Cutting it to 80% means reduce your exposure to big overnight swings significantly.
So batten down the hatches?
Pretty much. It's a clear signal.
Hmm.
Brace for big, maybe unpredictable moves. And it's not just a busy week. It's this specific mix of events. They could feed off each other, create a feedback loop.
Okay.
It becomes less about one event, more about the combined system risk, like multiple storms converging. Volatility is almost guaranteed.
Right, a perfect storm scenario. Okay, lay out these events for us. What's hitting when?
Okay, buckle up. Tomorrow, July 29th, U.S.-China talks in Stockholm. Medium sensitivity for supply chains, July 30th. Bank of Japan policy review. Again, medium sensitivity, maybe hints about intervention.
Okay.
July 31st, the big one. Fed rate decision and the press conference.
Yeah.
High sensitivity. Markets hanging on every word about future guidance.
Right, the Fed always moves markets.
Always.
Right.
And then August 1st, EU and Mexico activate those 30% tariffs. High risk for direct consumer inflation.
Wow.
So you stack all that up, you see why the warning.
Yeah, absolutely. A very packed, very high-stakes few days. Let's dive deeper into digital currencies then, because those headlines are eye-catching. Spot prices. Bitcoin, $119,200, up a bit, 30% year-to-date. Ethereum, $3,903, up more, 60% year-to-date. And XRP, $3.62, up 110% year-to-date. Total market cap, $4.01 trillion. Serious numbers.
They're serious numbers.
Yeah.
But the really fascinating part, I think, is in the ETF flow data. That flow divergence is key. Last week, ending July 25th, Bitcoin ETFs, net outflow, almost $95 million out.
Out, okay.
The Ethereum ETFs, massive net inflow, $1.85 billion in.
Whoa. Okay, that's a huge difference. Bitcoin, the supposed king, seize money, leave these funds while Ethereum gets flooded. Is this just quick profit taking on Bitcoin? or something more
Yeah.
fundamental, a reevaluation?
Great question. And the briefing gives us clues. Bitcoin did see its inflow streak break July 22nd, $131 million out. That was flagged as the first sign of profit-taking at record highs. Makes sense.
Oh,
But compare that to Ethereum. Inflow's accelerating. 14 sessions straight, nearly $5 billion in July alone.
incredible.
And the why is explicit. Institutions are chasing staking yield narratives.
Ah, there's that yield again.
Exactly. This isn't just speculation anymore. It shows institutions getting comfortable with crypto's mechanics, participating. It hints the ecosystem is maturing. Utility, passive income, they're becoming as attractive as just price going up, maybe more so.
So it's not just what it is, but what it can do for you. That's a big shift. What about long-term conviction then? Forget the short-term flows for a second. What's the underlying structure telling us?
Well, looking at Bitcoin's market structure, it actually looks quite bullish long-term, despite those recent ETF outflows. Bitcoin's illiquid supply ratio coins held tight, not moving, hit 79.8%, highest in 5 years.
Yeah, oh, so people are holding on.
Serious long-term holder conviction, as the brief says. Plus, exchange balances dropped 50,000 BTC recently. That's like $5.9 billion.
Less available to sell immediately.
Right. Reduces that immediate sell-side pressure. And in derivatives, the funding rate for perpetual swaps cooled off a lot. Went from overheated levels mid-July back down to something much healthier. Suggests the speculative frenzy, those leveraged longs, have calmed down.
Okay.
So Bitcoin itself, healthier structure, less froth maybe, even with that ETH rotation in ETFs.
That's a really important distinction. Short-term flows versus long-term health. And of course, none of this happens without regulation. The briefing calls it the bedrock. What's new there?
Yeah, regulation is huge. We've had major legislative wins recently. The Genius Act for stablecoins, the Clarity Act for market structure, they're law now.
That's big.
It is. Plus, the Anti-CBDC Act is heading to the Senate. But maybe the most impactful thing right now, Treasury clarified stablecoin rules. Custodied stablecoins under $10 billion market cap get a 2-year break from certain Basel III liquidity rules.
Basel III, those are the bank capital rules, right? To make sure they have enough liquid cash.
Exactly. And this exemption, it's catalyzing regional bank participation. Suddenly, smaller banks feel safer getting involved. Big step for mainstream adoption.
Right. That sounds like it really opens the door for traditional finance. Okay, so for you, the listener, listening right now, practical takeaways, strategic moves, risk flags.
The briefing lays out a tactical trade grid, pretty direct. For Bitcoin, add-on dips, 113K, 115K range.
Okay.
For Ethereum, overweighted.
Yeah.
Entry $3,450. Targets, $4,100 short-term, maybe $5,000 by year-end. There's also a specific trade idea for Solana versus Bitcoin.
But there are risks, right? Especially with prices up so much.
Always. And the brief flags it clearly. The Crypto Fear and Greed Index is at 78. That's elevated optimism. Maybe too much optimism.
Bordering on greed.
Could be. So the advice is strict adherence to 25% trailing stops, especially on high beta altcoins.
High beta altcoins.
Yeah,
The ones that swing more wildly than Bitcoin or Ethereum.
precisely. Manage that risk if things turn south quickly.
Good, practical advice. Okay, so digital assets are seeing big shifts. Institutional interest, yield chasing, clearer rules. But how does this connect back to the traditional world? The dollar, FX markets. How's the dollar dancing, as you put it, amidst all this?
Yeah.
Especially with tariffs looming.
Well, the DXY, the dollar index, its softness come from a couple of things. Lower real yields on treasuries, plus those tariff-related growth concerns. Elsewhere, the euro's stronger. Why? ECB hinted they'll pause rate cuts, plus Eurozone GDP surprised positively.
Okay.
Sterling, the pound, underperforming. Weak UK retail sales, political uncertainty still hanging around. Yen weakness continues. BOJ sticking with yield curve control. Spot price getting close to 1.50 against the dollar. That's a big psychological level. Intervention talk is getting louder. Governor Kuroda even said they'd act decisively if moves get disorderly.
So central banks everywhere are walking a tightrope, managing inflation, growth, currency, often pulling in different directions.
Yeah.
What are the key signals from the Fed, ECB, BOJ, according to this briefing?
Fed's expected to hold rates this time. But everyone's watching the dot plot skew, where officials see rates going later, and any comments on reducing their balance sheet. Clues for Q4 cuts.
Right.
ECB. President Lagarde mentioned a data-dependent approach. Their September meeting is now seen as live, maybe for a small, temporary QE program. a mini QE bridge facility.
Interesting. And the BOJ.
BOJ held firm, as we said. Kuroda just repeated they're ready to step in on the yen if needed. It's a really complex balancing act globally.
And how does this all link back? Currencies, central banks, how does it tie into other assets? Especially with tariffs in the mix. What about correlations?
Good point. Look at copper. That 50% U.S. tariff threat, it's keeping industrial metals volatile. And that spills over into currencies like the Aussie dollar, emerging market FX too. Shows how trade policy hits commodities, then currencies.
Right. Interconnected.
Exactly. And the brief also highlights gold, up nearly 16% year to date. It's acting like that classic hedge against inflation worries, maybe fueled by those tariffs.
Okay. So the big picture is complicated. Here's where it gets really interesting for you listening. With everything we've discussed, digital assets, FX, central banks, tariffs, what are the actionable takeaways? Strategic allocation, risk management, what did the briefing suggest?
Okay, let's boil it down. For digital assets, keep a core Bitcoin holding, maybe 5–7% of your crypto allocation. Buy dips around 113K, 115 collars. Overweight Ethereum, maybe 10% of your crypto sleeve. Chase that staking yield premium. Targets, $4,100, then $5,000.
Got it.
Diversify into other strong, compliant, large-cap altcoins. SOL, ADA are mentioned. Aim for them to outperform Bitcoin by 20–30% over 6 months.
Okay, that's the crypto part. What about FX?
FX strategy, USD neutral. So don't bet heavily long or short the dollar overall right now. Be net short Europe and commodity FX. But keep dry powder. Keep cash ready to deploy after the Fed meeting.
Okay, wait for the Fed's signal.
Right. Maybe buy some yen optionality. Those 2-week USD/JPY call spreads are suggested. Gives you upside if the yen weakens further towards 150, 152. And stick with tactical shorts on the British pound. Growth outlook is poor. Political risk remains.
Makes sense. And overall risk management across the whole portfolio.
Key points there. Cap any single crypto coin exposure at 5% of your total portfolio value, NAV. Use those 25% trailing stops so that the fear and greed index stays high, above 75.
Discipline.
Crucial. Boost your gold allocation to maybe 7% of the total portfolio. That hedge against tariff inflation surprises. And importantly, keep at least 15% of your portfolio value in ultra-safe AAA money market funds, basically cash through that August 2nd trade deadline. Liquidity is king during volatility.
That is a really comprehensive set of takeaways. Packed, but super helpful. Okay, let's quickly recap the core insights from this briefing. 1, digital assets look like a buy-on-dip play. Regulation, ETF flows are positive drivers. But stay disciplined, greed levels are high. 2, dollar weakness. Probably cyclical, not a long-term structural shift, so maybe hedge your bets around the Fed meeting and those trade deadlines.
Right.
3, tariffs are a worry, need vigilance. But assets are holding up okay for now. So focus on positioning for short-term volatility spikes, not necessarily broad de-risking yet.
Yeah, that seems right.
And 4, you need a balanced hedge framework. Gold, maybe some options, definitely liquidity buffers, crucial for navigating this packed event calendar.
Exactly. And maybe one final thought to leave you with as you process all this. Think about that intricate dance we discussed. Central banks, GDP surprises, tariffs. Now, consider this. What if there's an unexpected turn in those U.S.-China trade talks tomorrow in Stockholm? How could that specific event ripple through everything? Could it force an immediate rethink, not just of asset prices, but of what risk even means in your portfolio right now?
That's a really potent question. Highlights how quickly the landscape can shift, forcing that constant reevaluation. Thank you for joining us on this deep dive into the global financial landscape. Keep exploring, keep questioning. We'll be here next time to help you cut through the noise.